Which is more important, fiscal policy or monetary policy? Does it really matter anyway what your answer is? Discretionary fiscal policy, on the other hand, involves deliberate changes in government spending and taxation to influence the economy. During a recession, expansionary fiscal policy can be employed, which entails increasing government spending or reducing taxes. By injecting money into the economy, the government can boost aggregate demand, increase production, and create jobs. For example, the United States government's fiscal stimulus package during the 2008-2009 financial crisis helped prevent a more severe recession and facilitated economic recovery. Conversely, during an economic boom, contractionary fiscal policy can be used to reduce inflationary pressures by decreasing government spending or increasing taxes. In this way, fiscal policy serves as a counter-cyclical instrument to mitigate the negative effects of economic fluctuations on the population. Fiscal policy decisions are often influenced by political factors, as politicians may prioritize short-term electoral gains over long-term economic stability. This can lead to unsustainable fiscal policies, such as excessive government spending or tax cuts, which can create budget deficits and increase public debt. Monetary policy plays a critical role in shaping the macroeconomic environment of modern economies. Central banks, as the primary architects of monetary policy, are tasked with maintaining economic stability, promoting sustainable growth, and managing inflation. This discussion will explore the fundamental objectives of monetary policy, the various tools central banks employ, and the impact these policies have on economic growth, inflation, and unemployment. Additionally, the discussion will briefly touch on the challenges faced by central banks in implementing effective monetary policy. Hi there, my name is Mike, and welcome to my channel, where I discuss economics and finance topics of global interest. Today's discussion is part 2 of the series on macroeconomic policy. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. The primary objectives of monetary policy are to maintain price stability, support economic growth, and achieve full employment. Price stability is crucial for a healthy economy as it helps to preserve the purchasing power of the currency, facilitates trade, and encourages investment. Sustainable economic growth ensures that the living standards of the population improve over time, while full employment reflects an efficient utilization of labor resources. Central banks employ a variety of tools to implement monetary policy. The primary instruments are 1. Open market operations. Central banks buy or sell government securities in the open market to influence the money supply. Purchasing securities injects money into the economy, while selling them removes money from circulation. Policy rates. The central bank sets short-term interest rates, such as the federal funds rate in the US, to influence borrowing costs and credit availability. Lower rates encourage borrowing and spending, while higher rates promote saving and discourage excessive credit expansion. 3. Reserve requirements. Central banks may adjust the reserve requirements for commercial banks, which affects the amount of money banks can lend out. Higher reserve requirements restrict lending, while lower requirements enable banks to lend more. 4. Forward guidance. Central banks can influence market expectations through communication about the future path of policy rates, providing clarity and reducing uncertainty. The effectiveness of monetary policy is determined by the transmission mechanisms through which it impacts the economy. These mechanisms include A. Interest rate channel. Changes in policy rates influence market interest rates, affecting borrowing costs for households and businesses. Lower interest rates incentivize borrowing, investment, and consumption, while higher rates discourage them. B. Exchange rate channel. Changes in interest rates can impact exchange rates, as higher domestic interest rates attract foreign capital, leading to an appreciation of the domestic currency. This affects the competitiveness of exports and imports, ultimately influencing aggregate demand. C. Asset price channel. Monetary policy can influence asset prices such as stocks and real estate. Lower interest rates can boost asset prices by encouraging borrowing and investment, thereby increasing wealth and consumption. D. Credit channel. Changes in interest rates and reserve requirements can impact the availability and cost of credit, thereby affecting lending and borrowing activities. I will return to the topic of the transmission mechanism of monetary policy in a future episode. Monetary policy has both short-term and long-term effects on economic growth and stability. In the short run, expansionary monetary policy can stimulate economic growth and reduce unemployment by increasing aggregate demand. However, excessively expansionary policies can lead to inflationary pressures, which erode purchasing power and can ultimately result in economic instability. In the long run, sound monetary policy helps to foster a stable macroeconomic environment characterized by low and stable inflation, full employment, and sustainable economic growth. By maintaining price stability, central banks create an environment in which businesses and households can make long-term plans and investments with greater certainty. More specifically, monetary policy can have the following significant effects on various aspects of the economy. 1. Economic growth. By influencing interest rates and credit availability, monetary policy can stimulate or dampen investment and consumption, thereby affecting economic growth. Expansionary policies such as lowering interest rates can boost growth, while contractionary policies such as raising rates can slow it down. 2. Inflation. Central banks can control inflation by adjusting the money supply and interest rates. When the economy overheats, central banks can raise interest rates or decrease the money supply to curb inflationary pressures. Conversely, when inflation is too low, they can lower rates or increase the money supply to stimulate demand. 3. Unemployment. Monetary policy can impact the labor market by affecting aggregate demand. Expansionary policies can lead to higher demand for goods and services, resulting in increased production and employment. In contrast, contractionary policies can reduce demand, leading to lower production and higher unemployment. 4. Financial stability. By controlling the money supply and influencing interest rates, central banks can help prevent financial imbalances and maintain stability in the banking sector. This is essential for ensuring the smooth functioning of the financial system and supporting economic growth. Despite the significant role of monetary policy in shaping economic outcomes, central banks face several challenges in implementing effective policies. These challenges include A. Time lags. Monetary policy actions often have delayed effects, making it difficult for central banks to respond promptly to economic shocks. B. Uncertainty. Central banks must make decisions based on incomplete information and imperfect models, which can lead to unintended consequences. C. The zero lower bound. When interest rates are near zero, traditional monetary policy tools become less effective, requiring the use of unconventional measures such as quantitative easing. In conclusion, monetary policy is a powerful instrument used by central banks to achieve macroeconomic objectives, such as price stability, sustainable growth, and full employment. By employing various tools, central banks can influence interest rates, money supply, and credit conditions, which in turn impact the broader economy. Despite its limitations, monetary policy remains an essential component of modern economic management, contributing to overall economic stability and prosperity. Thank you for watching. Please like and subscribe to my channel for more videos on economics and finance.